Bom dia a todos e bem-vindos de volta ao Café com Sócios aqui da CIX Capital. Meu nome é Carlos Baltazar, eu sou CEO e sócio da CIX Capital. Estou aqui com o Fábio Bergamo hoje, que é nosso associado. Começou a trabalhar conosco tem mais ou menos um pouco mais de 2 meses agora. E ele participa de todas as atividades que a gente faz na parte de estruturação e gestão. A gente vai começar aqui na sequência com o John Salib, que é sócio da Castle Partners, para falar sobre uma tese de investimento que temos de distressed credit, ou seja, crédito estruturado. Então, solta a vinheta aí, por favor. A próxima apresentação agora vai ser em inglês, pessoal. A gente já está aqui com o John conectado, que é nosso sócio da Castle. Hi, John. How are you? We are doing well. I can't hear you yet. I don't know if everybody is hearing John.
Sorry, I had it on mute.
Oh, I think it's yeah, we hear you perfectly now. I think it's the sentence we heard the most in the pandemic, right? You are on mute, so I think everyone is used to that. So thank you for joining us, John, to this event today. We are very pleased to have you here with us. As you know, we have Fabio as well, that
Hi,
will
John.
be working on this project. So is Ethan also connecting with us?
I think so. Hopefully, but let's just continue on.
Sure, perfect. So I'll just give a quick introduction to everyone here that's listening to us on Castle and Six. So we'll send you the presentation later on. So you already know what we do and the way we like to look at our partnerships. We have a very productive and very long-lasting relationship already with Castle, which is a New York-based firm. John will tell a lot more about what they do, but they are essentially focused on real estate, both on the equity side and debt side. They have been been structured as a firm after the crisis of 2008. So we are more or less in a scenario of a crisis with the pandemic. So it will be interesting for him to give us his opinion on the background of everything we are living right now and the upcoming years, right? So just to give everyone a quick background on this, so we started conversations with Castle back in 2016, and then on 2017 and 18, we decided to do a first investment with them on 79 East 30th Street in New York. So it's a development. We'll show us a couple pictures to you guys pretty quickly. As the background from Castle is on the opportunistic side as well, on credit, we started discussing about creating a fund for this. We'll tell a little bit more about the opportunity in the upcoming slides. Just to give you here a quick example on the development. So you have on the left side the perspective of the building. It's really close to the Empire State Building for everyone that has been in New York already. So it's a couple blocks only, and we are already on the 24th floor of the building. So now we are in the process of doing the finishes. So maybe you can tell a little bit more about this project and how we came together for these projects, John, and then continue from there.
Sure. Thank you, Balthazar, and thank you everyone for joining today. We're very happy to be here. We've had a great partnership with Six on this initial project, which we've been working on for a few years now. As Balthazar mentioned, we've topped out the 24th floor and look to complete the project and lease it up within the next 12 or so months. It's an interesting project in that I think that it's the best possible thing that we could build for the market today. We're building small rental units, so studios and and one bedrooms that will be catering to young professionals that want to live in this kind of trendy, very new, hip, trendy part of Manhattan. And there's a lot of development going on in the area, and also a lot of companies that are moving to the area. So Amazon's headquarters is only going to be 5 or 6 blocks north of our property. Facebook's just signed a brand new lease, which is going to be 3 blocks west of our property. So location-wise, we couldn't have been luckier.
Very good.
We're excited to be partners with SIX on this project, and so far it's been great.
So are we, John. Thank you so much for that. I think Ethan just joined us. Maybe we can connect him to the presentation now. I think he just connected. So just to give you a quick introduction on Ethan, guys. So John is the founding partner of Castellan, and Ethan is the director of investment. So he is on the day-to-day of the operations. I think he just connected. Do you hear us, Ethan?
Yeah, I hear you guys. Can you hear me?
Okay.
Perfectly.
Yep.
Thank you for joining.
Great. Thank you.
Back to you, John.
Okay, I think we can move forward. So just to give a more robust background on who we are. So Castellan was founded about 10 years ago by myself and my brother Paul, really in response to the financial crisis and our view that it was a once in a lifetime opportunity to buy New York real estate at distressed prices. Our family has had a history of owning and operating real estate in New York City going back to the 1970s. So Paul and I grew up being exposed to real estate as an asset class. And then when we graduated from school in the mid 90s, we had more institutional careers within real estate. So I worked for a predecessor to Citigroup, which was a firm called Salomon Brothers in New York, and there I was focused on actually bridge lending and non-performing loan acquisitions. And I spent the late 90s and early 2000s in Japan, really focused on buying non-performing Japanese mortgages from banks and insurance companies, which was really where I cut my teeth on distressed investing. And at that time,
I think we lost it for a second. I think we lost John for a second.
I'm here. Can you hear me? Eitan, can you hear me?
Yeah, I can hear you, John. Yeah, I think continue. I think.
Okay, I'm gonna continue anyway. So in Japan, I was focused on buying non-performing loans from Japanese banks and insurance companies, which was a great experience because we were doing that 10 years later in New York. Okay, I think
now we're back.
We're back here.
Yes.
Okay. So what I was saying was I started my career at Citigroup, and I was working in Japan in the late 90s and early 2000s, focused on buying non-performing loans from Japanese banks and insurance companies that were trying to clean up their balance sheets after the real estate bubble burst in Japan. And then I ended up moving to New York and working in the hedge fund space for about 10 years before we started Castellan. And Paul, briefly, he worked for a private equity firm focused on multifamily investments across the country, and is also an adjunct professor at NYU, where he's been teaching in the master's program for over 10 years. So we acquired our first property as a firm in 2009, and over that time, we built up a very significant infrastructure to asset manage our properties, manage the construction projects across everything that we're doing, And today the firm is really divided into three different segments. We own and we acquire, own, and develop properties. We make loans to other developers on their properties, typically short-term loans on transitional assets. And we buy defaulted loans from banks where we think there's compelling value there. So we'll go to the next slide, please. So just in terms of what we've done on the acquisition side, since inception, we've acquired about 71 properties. And really most of that occurred between 2009 and 2014. And during that period, we felt that we could buy, very high quality assets that were underperforming their potential, and we would implement a value add program. And we also benefited from, an appreciating market. So we sold, of the 71 that we acquired, we sold about 40 of them. We've been able to deliver about a 19.7% net IRR to our investors and 1.9 times equity multiple, which investors are happy with because it was in excess of what we promised in the beginning, which is always nice. Next slide. This slide really just shows the deal by deal returns. I would say that the thing to note here is that I think the smallest deal that we did was about $5 million, and the largest deal that we did was about $42 million. And this is really the segment of the market that we tend to focus on, which is, kind of smaller middle market. And the reason why we like this space is that, we don't want to be competing with, multi-billion-dollar, very sophisticated private equity firms. We feel that our informational advantage, our operational advantage, is really in sourcing and executing on these, kind of smaller to medium-sized properties. We're much more sophisticated generally and much better capitalized than the owners that we're typically buying from. Next slide. So I'm just going to walk through a couple of examples of deals that we did post the last financial crisis, just to give you an idea of what we think is possible here in the current environment. So this is a building here, 93-unit apartment building located in the northern part of Manhattan, which is a kind of a working class area. The previous owner was a private equity fund that was in the process of liquidating their portfolio because they had problems as a result of the crisis. We purchased the property in February of 2010 for about $6.5 million. And when we owned the property, we put significant capital into it, renovating about 51 out of the 93 apartments. And typically on these renovations, we would increase rents anywhere from 30 to 100%, depending on the individual situation. And then we sold the property in 2015 for $14.3 million, which was, ended up being a net 23.5% IRR and 2.6 times equity multiple. So this is a similar situation. So we bought it from a very motivated seller, again, a private equity fund that needed to sell. We bought it for a very good price. We renovated most of the units in this building. Again, acquired it for about $6.2 million in 2010. Sold it for $18 million in 2016, which was a 3.5 or 28% net IRR and three times equity multiple. And I will say that the reason that we were able to generate these returns was really twofold. One was the entry point, coming in, post-crisis, buying from a seller that has, structural reasons to sell. They're not selling because they think it's a bad investment. They're selling because they have a fund that they need to wind down, or they've got other problems. And, these were relatively small assets for the funds that owned them. So it's likely that they didn't pay, as much attention to the assets as they could have. And so that left the opportunity for a group like ours, who's a very, who's a micromanager of assets, to create, this huge amount of value.
And John, I think one point that you just mentioned is the entry point. When we look at both samples here, examples of transactions, both properties have been acquired in 2010. So this was an opportunity, right? So entry point on a buying opportunity. So we had a crisis in 2008, and then it takes a little bit of time for the market to develop. So you have that opportunity to acquire it for whatever reason it is, right?
Yeah. So actually, in 2009, we really didn't buy much because the market was frozen. And then by 2010, things started to loosen up. Banks started to sell loans. The market started to mobilize again, and that's, I think, kind of where we are today. Not much is trading because the market is still kind of trying to figure out where it is exactly.
Understood. Thank you.
So I would say that the returns were a combination of the entry point and the value add, right? So we're not making market timing bets. We knew when we bought those assets that there was a huge amount of upside in the rents for someone that was willing to, invest the capital and, apply the human resources to execute on the business plan.
Perfect.
So, so the market, appreciated, and by, 2014, 2015, we recognized that it was more difficult for us to find acquisitions that met our risk and return criteria, and sort of recognized that there was actually a very compelling opportunity to become more of a lender in our space. Okay. And so after the financial crisis, a lot of extra restrictions and regulations were put on banks that really forced them to pull back from certain segments of the market, leaving an opportunity for private lenders to step in. So we created a bridge loan program where we would provide first mortgage loans to other developers for situations that banks were not really suitable. So these were typically either very time-sensitive transactions, so someone that needs to close a loan in a month, or it takes a bank 3 months to close a loan. And especially in New York, things need to happen quickly in many circumstances. So we're a group that is very flat in terms of our decision making, and we can move quickly to suit the needs of borrowers. And then the other significant component of what we're doing is our transitional assets. So the borrowers are undertaking a business plan that would be similar to what we would do. They're renovating apartments. There's going to be vacancy for some time until they release the units. And banks, their appetite for underwriting pro forma rents on vacant apartments is relatively low and has been. So a group like ours, who knows the market, understands what market vacancy rates are, what market rents are, we can get comfortable lending on these assets and understanding the value as equity from an equity perspective much more easily. And so we created a program where we're making low loan to value loans. So the weighted average loan to value of our portfolio is currently sub 50%. So the borrowers generally have a lot of equity that is junior to us, which provides a cushion of a margin of safety for us as investors. We're lending today at about 8% rates, and we do use leverage to enhance the returns. So we borrow from banks at roughly 5%. And so what that does is it allows us to target, kind of a 9 to 10% net yield to our investors, which has been, I think, in the relative to other sort of income-oriented investments, has been quite good. And considering the loan-to-value ratios that we've been able to put the money out at, I think it's a compelling risk-return investment. So we've closed close to 100 loans, roughly $600 million. And we see we have a lot of deal flow through the relationships that we have, and what we close on a very small percentage of what we see. So somewhere in the neighborhood of 2%. So it's for Eitan and his team, there's a lot of grinding through deals that ultimately don't make sense for us, in order to find the ones that do. In terms of where we lend, our bias has historically been towards the New York area. And the reason for that is just that's where we've been. Our relationships are there. Our sourcing capabilities are extremely strong there. We have been making an effort to diversify geographically. Currently, we have about 20% of the portfolio in the Los Angeles metro area, and then about less than 10% of the portfolio is elsewhere. We do have a bias towards residential properties and mixed-use residential and retail, which make up the bulk of the portfolio. But we do have loans on other asset classes as well. I would say that our real focus on this strategy is, when we make a loan, we really our ultimate underwriting criteria is, would we be happy owning this property at our basis if the borrowers don't pay us back? And if the answer to that is no, we're unlikely to be making the loan. So in the event of a default, because we're not a bank, because we're not a hedge fund, we're an owner and operator of real estate, if there's a default, those could be very interesting opportunities for us.
John, if we go back to that slide, you see the shape very, very more concentrated in residential, right? You see half of the investments made in residential. Looking forward, how do you see that shape developing, assuming we know that hospitality and retail now are under a lot of stress, right? How do you see that in the coming years in terms of sectors?
I think we've been trying to make this a low risk product. We take we have construction projects. We have more equity oriented projects. So what we're not and you can see that in the loan to value area. I mean, our bias is towards residential because we have a very significant expertise in residential. For us to when we make loans on other asset classes, it's because the loan to value is very low. Okay, almost, we want them to be kind of almost no-brainer types of basis, where the borrower is not really looking for maximum debt. They're happy putting a lot of equity in. We're in a very safe position. So we don't necessarily say, we have to be half in residential. but it's hard to find those types of loan opportunities where where borrowers are saying, okay, well, we're happy to have more than 50% equity in the properties. So it is really a bottom up approach to the portfolio construction. This is just an example of a loan we just closed in September. So this is post pandemic loan that we made here. So we provided a $15.7 million loan to finance the acquisition of a 76 unit condominium project in Queens. And this is sort of typical of what we would see. The borrower is putting in roughly $13.5 million of equity junior to us at closing. It's a 24-month loan. They're using the loan to help them buy time to sell the units. Our loan to value ratio is under 50%. We're the first in line to get paid, and at a 7% rate with our borrowing, we can expect to generate a 12.2% yield on our equity. And again, ultimately, if they didn't pay, and we believe they bought this well, but if
Oh, I think we lost John there for a second, so he should be returning shortly. So, Ethan, actually, I was just going to ask John a question. How do you see this actually comparing? So this opportunity we have now comparing to the 2008 event crisis. How do you see this comparing to now? Have we lost Ethan as well? Are you there? Oh, perfect. Hi, Ethan.
I'm here. Can you hear me?
Yes, perfectly.
Yeah.
So how do you see that compared to 2008? So we're seeing like an opportunity forming, right? With all of that what Jen was just saying. So how do you see that comparing?
Yeah, so it's interesting. The credit market and what we're doing in terms of lending has definitely tightened. So a lot of our competitors actually have almost stopped, lending. And because of that, we're able to actually have a much better deal selection. So we're choosing much better loans to make, and our the number of loans and the different options that we have are definitely superior probably than pre-COVID, because the competition has obviously diminished. In addition, you're also seeing, and I think we're going to get to this shortly, but you're also seeing, because of the number of lenders that have exited the market, there's less of an ability for a lot of owners to refinance their mortgages, that they may have a maturity issue or a payment issue. And typically, whereas a year and a half ago, there'd be another source of liquidity for these borrowers, and there are other private funds they can tap into, that's actually dried up significantly. And so you're seeing on the lending side, you're definitely seeing, at least in what we're seeing better deals. That we're trying to keep our returns the same or better, but we're also seeing better opportunities, and you're also seeing less liquidity out there for other borrowers, which is going to provide opportunity for us to buy defaulted debt and notes in the market, because those borrowers do not have another source of capital that they could tap into.
That's very good. Thank you so much, Ethan. Thank you for. I think you just returned, right, John? So do you hear us?
Yeah, I'm here. Yeah, I'm here. Sorry about that.
No worries. So we were just talking about the opportunity right now when comparing to 2008. So Ethan was just explaining to us a little bit about that. So the whole opportunity consists and lies on the fact that things are changing. Liquidity of the market has changed, and people still need to make the terms that they have agreed on their loans and everything on the commitments they have done. So it's this is the reason it's returning now as an opportunity, right? So we have I think we lost the slides for a second. So maybe I have just received a question here from the audience. So since Castlin is based in New York and everyone has seen the pandemic, right, in New York, and everyone very concerned, and we have seen a little bit of an exodus from people from the city. So how could you compare what's happening, and how will New York remain as New York, right, as the way we know? How do you see this developing and contrasting to the opportunity of buying assets right now?
Yeah, so I think one thing I would say is that obviously this is there's a lot of distress in the market, but obviously we haven't experienced anything like the pandemic before, and that's obviously very different than what happened 10 years ago. I will say that our view continues to be that New York City has very significant competitive advantages that don't exist anywhere in the U.S. and possibly the world. Right now we're in a situation where still most people are working from home, but life is coming back to the city, and what you read in the newspapers and what sells newspapers is not necessarily what you experience on the streets. Okay, so if you were in Lower Manhattan today, walking around, you would feel like it feels pretty normal. Some of the business districts do not feel as normal, and that's reflected by the fact that still most people are working from home. But there have been some very big bets in New York, even during the pandemic. So again, Facebook just signed a new lease, a huge one, in the Penn Station area. Like, they could have pulled out of it, they didn't. Google, Amazon continue to expand and add resources to the city. So we're at a point now where things are stressed, but our view is that once things get back to normal, New York is going to bounce back more quickly than most places.
Very good.
Yeah, and John, we have another question here. You hear a lot about Oaktree, Blackstone, and some other players raising massive funds for distressed assets. How do you see Castlin CIX differentiating from these massive funds? I think you touched in a couple of points during the presentation, but if you could go, talk a little bit more about
we had it on the slide. The commercial and multifamily mortgage market in the U.S. is about $3.7 trillion. So it's an enormous market. There is a lot of capital, being raised. I think, some of these funds have raising, $10 billion funds to target this investment strategy. But, our focus is really, we're going to be buying from banks that we have relationships with. These are, smaller, local, community banks, where we're buying loans that will probably be between $15 and $30 million, most of them. If one of these big private equity firms has a multi-billion-dollar fund, it's just as much work to do a $10 million loan acquisition as it is a $500 million loan acquisition. And so it's really, we're not going to be fishing in the same waters as these groups. And also, I think that these smaller banks, they're not set up properly to be able to maximize value in a loan that they want to sell. So they don't have the resources to run oftentimes don't have the resources to run a proper sales process. It will really be driven by relationship. We've bought defaulted loans from a lot of these banks in the past. So if we were, a reliable buyer that didn't waste people's time, we did what we said we were going to do, we closed, we were easy. Those things make a big difference in terms of the sourcing, and Eitan can probably add to that. But we want to have really an edge in terms of our ability to source compelling transactions. If we're bidding on a portfolio alongside 10 other bidders, in all likelihood, it will be bid up to a level where the risk return profile is not going to be attractive.
Very good, John. So I think we're approaching the end of our panel here. I think it would be interesting. So we haven't been able to log the presentation again. So we'll send to everyone after the call here of our event. So maybe summarizing what the deal is. So what we see the opportunity for the next years, right? So if this compares, so I think that it would be interesting to have you confirm or not if you see this as an opportunity like the one in 2008. So what's the short term, medium term, and long term for these opportunities to arise, as we were discussing, and important that we are seeing these opportunities more on the debt side, right? So we are seeing the debt side as a way to tackle these opportunities and acquire an interest in the deals, right, and be participant on that in a way possibly even to then use the value add strategy that you guys use so much and have a great track record on to bring value again to this asset that possibly is underperforming because of the lack of cash, right?
Yeah, so I think there's really three legs to the opportunity. One is just buying defaulted loans at very significant discounts to what we think the properties are worth, combined with, and then going through the process of bankruptcy or foreclosure to actually get title to the properties at a basis that we could not recreate in a traditional acquisition. Okay, and holding it, reinvesting in the property, adding our value, and then looking to exit, similar to what we did in 2010. The other opportunity would be to buy defaulted loans at a sufficient discount that it allows us to restructure the loan with the borrower to make it a performing loan again, which could result in very high current yields on our investments. Okay, that's another option. So kind of structured finance, buying the loans at such a discount that it gives us more room to work a deal with the borrower. And then lastly, or just instead of buying loans, just buying distressed properties that might not have had a lot of leverage on them, where we could, again, sort of because of forced selling or whatever the dynamics are in the market, where we believe that we're acquiring the property at a discount to what we, think it's ultimately worth, and we see the path on how we increase the cash flows and the value of the property. So similar to the post-crisis era 10 years ago, we think there's going to be a lot of chaos in the market. We think there's going to be a lot of forced selling by banks where they don't really understand what they have, but they need to sell because they have regulatory requirements. They're just non-economic sellers of assets. And for groups like ours that are willing to do the work to dig into these opportunities to find true value, I think there's going to be a lot of opportunity there.
Very good, very good. So, John, Eitan, thank you so much for joining us this morning. It was a pleasure having you again on our event here. I think you have shed a really good color on the market and the opportunity we have on distressed credit. And thank you so much for participating.
All right, thank you, Baltazar.
Obrigado a todos mais uma vez pela participação aqui nesse painel. A gente vai continuar aqui dando sequência para a nossa agenda. Obrigado a todos, um ótimo dia.